regulation is going to have various impacts on the ability for a marketplace business to even make sense. And then a huge impact on can an upstart business, a startup, break through that regulation, work with the regulators in an effective way to create a marketplace.
Welcome back to the Clean Techies podcast, where we interview the top climate founders and VCs to get their best advice for you. On this episode, I chat with Russell Sprole, founder and managing partner of Virta Ventures. Virta Ventures invests at the early stages, focusing on equity-light companies, often of which are software. We dive into the nuances of marketplace models, the potential of AI and ClimateTech, his journey with Full Harvest, and more. This is a great episode for software enthusiasts interested in its place in the ClimateTech ecosystem. As always, thanks so much for listening and enjoy the episode. All right, Russell, welcome to the show. How are you?
Doing well, Samil. Thanks for having me on.
The pleasure's all mine. Russell's another, for the audience, Russell's another one of my friends going back. I think we've been in communication for probably about a year about there. And so it's been a real pleasure to have anyone that I've known before I joined the podcast join on, because I didn't have this to offer when I first met you, but now I do. So super excited to have you on.
Excited to be here.
Yeah. Well, for the audience, why don't we just start off really quick with who you are and what you do today?
Russell Sprole. I am currently founder and managing partner of Virta Ventures, which is a pre-seed and seed stage climate tech fund focused on equity-light solutions in climate tech. That's typically software, marketplace, software-enabled services, business model innovation, things like that, across the climate tech sphere. So I've been building this fund for a year and a half now.
We'll definitely get into some of the specifics about what equity light means. One interesting thing that I'm really thinking about is for the people who are trying to do software investing in climate, how do they think about how their thesis fits into the overall climate ecosystem? Because a lot of the loans, grants, and funding you see are actually hardware based or deep tech based. So it's interesting in climate where not everything is as straightforward. But could you please just start off with the story of how did you start Virta Ventures and what is really the impetus behind starting up your own fund?
Absolutely. So I've been in the broader climate tech space for 15 years and won't go through all my background right now, but I started my investing journey when I left a company called STEM. I bought my options. This was many, many years ago. I invested in a couple subsequent rounds with STEM, and STEM fortunately went on to go public. But between the time of my first investment in buying my options at STEM and them going public, I really started going down a journey of writing really small checks into early stage climate tech companies. That started with investing via AngelList syndicates and then investing directly onto cap tables, larger checks, folks that I knew in my network and other folks that I met that were starting businesses. And over time, I got more and more involved with these companies, being an advisor on the board of one company. And as I built up that portfolio, which ultimately was 50 early stage climate tech companies, I was spending more and more of my free time on that. This was all on the side. So I had a day job operating, helping grow early stage startups as a CFO and other titles, but all along on the side, building out this early stage portfolio of 50 companies. And as I was doing that and spending more and more time on that, having more fun with it, seeing some early success, I decided I wanted to do it full time. And so the last company I was at, Full Harvest, I helped them scale from seed to Series B. And when I decided that I wanted to move on from that, I thought for a short amount of time about what I wanted to do next and really quickly realized that I wanted to move over to the investing side. And the impetus to start my own fund was really driven out of my general entrepreneurial bend. I've been a really early employee at a couple companies, kind of a late co-founder of a couple businesses, but I'd never really started my own thing, and I always had wanted to. And I frankly thought it was going to be a startup, an operating business, but it turned out that it was a fund. And so I started working on it a year and a half ago, and here we are today.
Shout out to our sponsors, Net Zero Insights. Net Zero Insight's mission is to enable the transition to a sustainable future by giving decision makers access to the leading market intelligence platform on climate innovation. Through the Net Zero platform, Net Zero Insights provides high-quality data and insights on the climate tech venture market by being the best at tracking organizations and funding rounds. I personally have had a great time using this to prepare for the podcast and researching companies, funding rounds, VCs, and the latest I need to know about the climate tech ecosystem. Use the link in our description to schedule your personalized demo with the team and claim your 10% discount. Thanks again to the Net Zero Insights team for sponsoring this show.
I think that journey is really, really interesting because a lot of the founders in the space that are interested in VCs, I think it's interesting that we get contacted a lot by people who are trying to understand from our guests too, like how they got into venture. But these founders haven't even invested themselves. And I feel like an angel portfolio, like an angel investing portfolio, whether it's being part of a syndicate or on your own, I feel like it's a very straightforward, but honestly underlooked way of just demonstrating that you have investing interest. And I think it's really surprising that many founders don't consider it. So I appreciate that background. I actually do want to press you a little bit on some of those experiences that you didn't get to name in the past. You worked specifically at, you worked within energy. You actually worked within the DOE for a short amount of time. And then I think you transitioned to SunPower Corporation, as well as STEM. So could you just talk through how that background factors a little bit into how you think about climate today?
Absolutely. So coming out of business school, I went to SunPower, and SunPower today looks very different than it did then. At that point, it was a module manufacturer. It was a solar developer across residential, commercial, and utility scale solar. Building out financial products for SunPower's residential channel, which is one of the jobs I had. SunPower really did kind of everything in the broader solar stack. And that was, again, my first full-time experience in climate tech. It was certainly not a equity light business, though I was working a lot on financial products and things like that. And then after 4.5 years there, I decided that I wanted to work at startups. And SunPower is a pretty large company, a fair amount of bureaucracy, as is per typical for large companies. And I went to STEM, and STEM was a really interesting company when I joined. They were actually doing some hardware at the time, building some of their own hardware because they needed to. It was really early in the storage days, and they were a developer. They were a financier of storage projects. They were building out software platform to help control and optimize the storage. So they're really doing everything, and that was a necessity because the industry was so young. And how those experiences have really informed my thesis. The thesis being equity light and generally software focused is that these industries like solar and energy storage and electric vehicles and other elements of the broader climate tech space are at the point where the industries are large enough that standalone software companies can be big enough and can play a huge part in helping scale out these technologies. That was not true in storage 5 years ago. That was not true in solar 10 years ago. But these industries have come a long way, and the projected growth over the next 10 years is massive. And so now is a time where you can be building these equity light businesses, software and marketplaces, some fintech and software enabled services around these hardware intensive industries. And those software businesses in and of themselves can be really, really large businesses. So that's really leveraging those experiences, kind of seeing what those companies needed to do at that time and how you can bring software to bear today to build a really, really large business. And after STEM, I went on to work at solar software company and Full Harvest, which is a marketplace in sustainable agriculture. So I moved to the more equity light software centric businesses and learned on the operating side how those businesses functioned and worked.
Hey there. Are you building a climate tech business and looking for very specialized talent? Consider reaching out to our sponsors, NextWave Partners. NextWave are experts in talent acquisition, recruitment, and retention across the climate tech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change yourself, feel free to reach out to NextWave at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page.
Before we get to that transition, I actually appreciate you talking about the growth of the industry and how that enabled you to actually look at equity light solutions. We had Sean Abramson from Third Sphere talking about how data and the collection of data through hardware, through different climate technologies, has actually enabled this massive opportunity for optimization companies, unifying the grid through software. Basically every hardware solution that requires connectivity has a software solution need on top of it.
Yep.
But that's sort of an extrapolation from what we've heard. In your experience, what in the past, call it 5 to 10 years, like you mentioned, has allowed there to be, like, what specifically has allowed there to be equity light businesses?
Yeah, it's a great question. I think it's a combination of a couple things. You talked about data. Many of these industries are still pretty antiquated, but the amounts of data that are being collected from the electric grid, from electric vehicles, from the built environment, and optimizing controls of buildings, like there is an insane amount of data there. It's being collected. It's not always well organized. It's not always easy to turn that into revenues and efficiencies, but there's a lot of data there. So that's number one. Number two, the size of these industries. The solar industry 10 years ago was tiny. It's 20, 30 times larger today and expected to be that much larger in 10 years. So just the sheer size of these industries. Electric vehicles, for example, now represent 7% of new car sales. That's expected to, triple, quadruple over the next 5 years, and the broader EV space is expected to grow massively. And so you're seeing kind of the tipping point in a lot of these industries in terms of their penetration, their scale, their size, and they all have a tremendous amount of data which software can leverage to create efficiencies, and increase revenues in each of these spaces. So really the size, the data, and I'd say the third thing that's really exciting right now is the ability to build software companies in a really cost-effective manner and create even more value with AI. Obviously, AI is a huge buzzword these days everywhere. But I think it's really exciting in the climate sphere for a few reasons. One is that many of the kind of subsectors within climate are still very under digitized, old school industries. And my thesis is that those industries, the startups in those that are building software companies in those industries, have a huge opportunity to leverage AI, and catch up with the incumbents who are not very innovative, not very forward thinking. There's other industries, ad tech and things like that, where the incumbents are the most innovative companies in the world, and they're going to leverage AI, and it's going to be hard to beat those incumbents like a Google. But in the energy industry and in the built environment world, in mobility and transportation, these are very antiquated industries in general. And so new startups have a huge opportunity to leverage the newest technologies like AI to catch up to the incumbents and probably surpass them, because the incumbents just aren't that innovative, aren't that forward thinking, aren't leveraging these new technologies in the same way that the upstarts are. And so huge opportunity from an investment perspective to take advantage of that.
I appreciate that overview. I think that is definitely like representative of what we would guess to be the growth of it, which is just there's more sample size for opportunity to actually implement software. Just to put sort of an idea behind the space that you're talking about, what would you say are like some of the most common like equity like companies that you see? So you mentioned like online marketplaces, it's software is a part of it. But if you like, let's say you get like 100 deals in a year, 1,000 deals in a year, what are generally the most common types of equity like businesses that you see?
Yeah, I would say there's a couple the couple business models that I see a lot. Marketplaces are becoming. I'm seeing more and more marketplaces today than I did through a lot of my angel investing. Marketplaces are very hard businesses to build, especially B2B marketplaces. But if you can build them. They're incredibly powerful. It's an incredibly powerful business model, and you can build a lot of things on top of that. And marketplaces are also very coming back to my earlier comment and kind of the under digitization in a lot of these sectors. Bringing marketplace software, software enabled marketplace business models into these sectors can really help kind of lower friction, increase efficiency, lower cost of acquisition, adoption across the board. And so marketplaces are a really exciting business model in general. Obviously, SaaS in general, whether that's data focused or you're providing leveraging AI to provide a service. One example being one of my portfolio companies, Tiba, is leveraging AI to help develop and operate utility scale energy storage more efficiently and effectively, and helping their customers increase their revenues and lower their costs with a SaaS product. I'm seeing more and more APIs as well. There are a lot of companies that are there's so many different disparate companies building software solutions or software enabled solutions that the data connections are often very, very messy. And so how do you efficiently and effectively connect a lot of that data and make that really, really easy? There's some API companies that are focused on that as their service, as their standalone service, and I've seen some really interesting business models there. So those are three. There's certainly many more, but marketplaces, SaaS, and APIs.
Hey there, thanks for listening to this episode. If you made it this far, it's likely that you're enjoying the show, so I wanted to ask your help. If you're enjoying it, please give us a review on Apple Podcasts and share with somebody in the same industry who might find this interesting. And if you're interested in getting summaries of these episodes, go subscribe to our newsletter that comes out on LinkedIn and Substack. Links can be found in the description. Thanks for your help in growing the reach of this show.
Got it. Do you think that there's a hesitance to actually use the software for between like third-party players? So this is I'll give you the background for this. There's been some things we've heard from founders about hardware founders who are trying to use deep tech, feeling really, really anxious about bringing in third-party software while they're developing the hardware because of data concerns, because of like IP considerations and things like that. Are you investing, or do you interact with software that deals with hardware, or is it mainly just software sort of like removed marketplace, financial business models, things like that?
The short answer is almost everything I'm investing in touches hardware in one way or another. Tiba is touching hardware very, very directly. They are integrating with batteries and telling them when to charge and discharge. Plug, another one of my portfolio companies, is a marketplace for used electric vehicles. They are obviously helping move and sell electric vehicles. They're not integrated directly with those EVs today, but their marketplace is moving actual atoms, large in mass. And so it's a variety of things that are directly integrated with hardware versus you're ultimately bits empowering atoms, bits moving atoms, in the case of Plug. And so it's both. To your question on hardware companies being hesitant to adopt third-party software solutions, I think that really comes down to what their core strategy is, what their core IP is. There's always the build versus buy trade-off. If it's a hardware company that software is a core piece to their what their value proposition is and what they're trying to build, then they're probably going to build more internally. But I'm sure there are elements of the software that they're leveraging that it makes more sense to use third-party software. So I think there's not one answer to this, and it really just depends on the hardware company's business model. Investors like recurring revenue businesses. So even with hardware businesses, you see hardware. These companies trying to build business models where they're building hardware, but they're selling it as a service, and they're selling software on top of it to get that recurring revenue. So they don't just sell a piece of hardware once and never get recurring revenue from it. And so that type of business model, typically you do have some meaningful software layer to it, and that probably makes sense to build a good portion of that internally if you are going to have that ongoing revenue stream. And so it really depends on the strategy of the company, the business model, and what they're trying to get at. But I don't think there's not many hardware companies out there that won't be leveraging third-party software in one way or another. It just is a matter of how core is it to their product and their technology.
Yeah, no, I appreciate that. I think that's really interesting because Silas, who is the co-host of the show with me, he generally likes to ask a question about exiting early, and that's something that's really difficult with hardware companies where you might not be able to get the audience and scale without the resources of a larger player, and so it creates this interesting dynamic where an early acquisition might be a win or a small win for a founder, but for these funds who are trying to invest in hardware and maybe more equity heavy businesses, to use the opposite term, they're not getting the returns of the massive amounts of capital they put into these hardware companies to build the hardware in the first place. So from a fund strategy point of view, it's not working. So I think it's interesting to see that, of course, software is what made, VC works on software. It doesn't suffer from the same issues, but it's interesting to see how hardware companies evaluate, like you mentioned, the build versus buy in terms of the software that they're using and how that relates to how other climate software companies can grow. Honestly, I think you mentioned it a couple times. Now I'm just curious. I'd love to hear about the story of you investing in Tiba and just what you saw early on and I guess what makes them so great.
Absolutely. Tiba is a company. I've known the founder, co-founder, and CEO, Michael Baker, since 2015. I actually hired him out of college at STEM. When I was at STEM, we worked together for a while at STEM. He went on to Cypress Creek, which is a large solar and energy storage developer. He worked on their internal tools and modeling for energy storage. And while he was at Cypress Creek, he realized that as an internally generated tool, he was really constrained on what he could build, what he could do. The resources of the company were not really behind him, so it was a challenge to build that internally and kind of create a lot of value from that tooling. And so he realized that there was an opportunity to create a standalone software business to sell to storage developers and operators. And that's when he started working on Tiba a few years ago. And I was kind of an informal advisor to him in the early days, and then invested in him and have stayed very close to that business. And they're doing really well, continuing to grow, and happy to dive deeper in any areas there.
As they were growing, like some of the founder, I mean, I think this is a general like startup trope, but running a startup is not about how to succeed, it's about how not to fail, right? And how many times you come close to that. What were some of the difficulties for Tiba early on in terms of growing their business? If you remember. Yeah.
It's still early days, so I don't want to project that Tiba's made it. They're doing well, and I fully have the fullest confidence in them and that they will ultimately succeed. But it's still very early days. Early challenges. I think it's always just hard to get those initial customers. They started focusing on developers, and while the value proposition was really strong, the price point, it wasn't a cheap product and isn't a cheap product. And so delivering that value, and proving out that it's worth spending the large amounts of money on Tiba's product was a challenge early on. And it's still a challenge, but I think they've been able to break through with a lot of those early customers and prove that out, through both trials and then just case studies, and really starting to build their brand in the industry where they don't have to do a free trial initially. So that's been a a learning curve for them, that I think they've started to break through.
I think one of the things that you see in climate is there are investors who are willing to invest in more crowded sectors like solar and solar development, and investors who are like mainly looking for IP, deep tech, research coming out of universities. And I think you can see some sort of people falling on, okay, I want to invest in something that would be novel, versus I want to invest in something that is in a more competitive industry, and that each comes with its own risks. One is a technology risk, and the other one is probably more of an adoption or a sales risk. In your experience, coming from a solar background, or at least having experience in this, how do you think about investing in a more, I hesitate to say crowded because not every part of solar is crowded, but how do you think about investing in a more crowded industry or more well-known industry like solar, versus an industry that doesn't really have a lot of market capture yet?
Yeah, it's a great question. I think when you look at more crowded industries, you have to understand what is ultimately going to win, or try to understand that. What are the things that are going to drive a company to gain outsized market share in an industry? And ultimately, that's going to often come back to the team and the vision and how they plan to go the business, what their go-to-market is, how their product is differentiated versus the competition, and just really the most important thing is just the capabilities and capacity of the team to execute and now to execute the competition. Age-old story of Google when they were getting funding. That was an incredibly crowded market. They were considered kind of late to the game, and Yahoo and many others were already in the search business, and that they out executed, and they had a better vision for what they wanted to build, and they obviously were a massive winner. And so I think you can't get scared away from crowded markets. There's a reason they're crowded. There's a huge opportunity, and if you can pick the winner or one of the winners in the space, you can still drive great returns. On the flip side, when a market is not crowded, there may be a reason for that. Maybe the market's not big enough. Maybe the timing isn't right. And so if you find a player that is a one of a kind, you have to ask yourself, what is the reason for that? Are they too early? Is the market not big enough? Or are they timing it really well, and they may have some first mover advantage? I don't. I look for both, to be honest. I don't try to just find markets that are established and massive, and I don't just look for markets that are more nascent. I've invested in both and can get really excited about both. And it just in the latter, where a market is more nascent and a player may be one of the only players in the space, you have to dive a lot deeper to understand, is the timing right, and is the market big enough or going to be big enough. But I'm also a really early stage investor, so it typically is going to come back to the team, and is the team a team that I feel can win in that space, whether it's a crowded space or not.
We wanted to take a quick break to tell you about another ClimateTech podcast. Well, literally. Ryan Grant Little hosts a podcast called Another ClimateTech Podcast, where he interviews ClimateTech founders and VCs, which, as I'm sure if you're listening to this podcast, you will love. So we highly recommend checking him out. The link will be in the description to this episode. Now back to the show.
Yeah, I think that's, like, hearing that is I think really informative, because there's now a lot of questions about how do you invest in these areas, especially given that now you have different types of loans and things that people are trying to vie for, and it's hard to exactly know where the real competitive edge is, especially in industries where, like, a lot of people kind of feel like they're doing the same thing. So I appreciate that. One thing I actually did before we move on to any other points, to wrap up some of your background, I was actually listening to another podcast that you've been on a little bit before this. We recorded this, the Found in the Rockies one, and I don't think we'd ever talked about this. You've actually won some Emmys. Is that correct?
I did in a former life. Out of college, I worked at NBC Sports for a few years on Sunday Night Football and the 2008 Beijing Olympics, and was fortunate enough to be on great teams and part of teams that won Emmys. So I've got a couple Emmys from that experience, but retired from sports television after a few years.
No, I remember when I was going through this that I believe this is right out of college, and I think it was really interesting to see the transition because I guess what was the transition there going from that production background to or media background to I guess a more operational solar and then climate and all of that.
Absolutely. So coming out of college, I frankly did not know what I wanted to do with my life or career, like many college graduates. And I thought about what I loved to do, and I played sports in college. I love sports. And so I ended up finding a job in sports television, thinking that that could be an interesting career path. I realized after a year that it was not where my passions lied. I think once the novelty of it wore off, I decided that I wanted to do something else and find a sector and an industry that I was more passionate about in the long term. And I did a lot of soul searching, and I'd always been really passionate about the environment and a lover and enjoyer of nature and the outdoors my entire life. And this was 2008, 2009. I saw a lot of challenges and opportunities around around climate change and clean tech, as it was called at the time. And I decided that I wanted to go into that. I didn't know exactly what that meant. I didn't know, what function I wanted to go into or what sector within the broader clean tech space, but I used business school to continue to explore that and ultimately landed at SunPower coming out of business school. So that was the transition from NBC Sports Television to SunPower.
Do you know Jay Kapoor from VSC Ventures?
Know of him, but don't know him directly.
So we just had him on a little while ago on the podcast. The episode's probably going to come out in like about 2.5 weeks. And so he comes from that live media sports entertainment world as well. I guess he worked at MSG Ventures. He helped them start that before transitioning to Launch Capital and then going into climate. And I think VSC Ventures' whole thesis is a lot more to do with PR and climate storytelling. So very clear thing there. But he obviously is a very big champion about how PR relates to climate. Do you share any of that same similarities or ethos around things that you can learn from in your time in this sort of like not seemingly related, but do you think there's any skills or learnings that you carry over to your day to day now?
Great question. I would say that storytelling in any sector and any industry is so important. I think the broader climate space can always do a better job of storytelling. To get more granular, early stage companies and early stage founders have to be good storytellers. The founder CEOs are often always the first sales people of the only salesperson in their company for many years often. They've got to be great storytellers. They have to know how to both sell the short-term and long-term vision to customers, to employees, to investors. And so the power of storytelling is pretty obvious. But I think it's something that early stage founders don't always appreciate and sometimes overlook and think, hey, I just go execute and the storytelling doesn't matter. And that's it's really hard if you don't have a compelling story to hire that great talent, to get those early customers, to get those big wins, and ultimately get investors. And especially in this current market environment where capital is harder to come by, in addition to executing and having great metrics, being able to share that compelling story is so critical. And that's obviously both from a communication and spoken word, from a visual standpoint, is really, really critical.
I mean, you're not going to find any pushback about storytelling and climate here. I think definitely agree with that. In terms of like the way that you looked at the options ahead of you, how did you at that time decide to join? Now, after working in industry for a while, how did you decide to join Full Harvest, and just generally the story behind that?
Yeah, absolutely. So I had prior to Full Harvest, I worked at two different companies between STEM and Full Harvest. So one was a company called Admiral's Bank, and we were working on standing up, growing, and spinning out their solar lending arm. Ultimately, we grew the business too fast within the bank and ran into some regulatory headwinds. So we unfortunately weren't successful with that. I went on to a solar software company for a short amount of time that very quickly got acquired by a much larger company, and I stayed on for the transition, but quickly realized that I wanted to go back to an early stage business. And the Full Harvest was founded by a business school classmate of mine, Christine Mosley, and she'd been building it for a year or two prior to my joining, but it was still very nascent, kind of seed stage company. Um, but she'd built a great foundation and a great small team, and wanted a kind of generalist business person to come in and help her grow that. And so we spent a few months chatting about what that could look like, and ultimately I joined not long before we struck out to raise our Series A, in CFO by title, but wore almost every hat in the business, but software developer. And amazing experience helping Christine grow that from seed to Series B. Brought on a number of great investors, and grew that business tremendously during that time, and definitely the most formative almost 5 years of my career helping grow Full Harvest.
From that experience, are there any, I mean, it was for the audience, especially as an outline, it was a marketplace business. So are there any, like, I guess, rules about marketplaces that you carry? And I guess depending on whether you're willing to share or not, are there any tidbits about marketplaces from that operational experience that you still keep in mind today?
Yeah, a couple things that I learned both from that experience and just in general looking at a lot of marketplaces. Um, First and foremost, really understanding the market dynamics on both the supply and demand side, and how fragmented the supply and demand is. If you have a highly concentrated supply base and or demand base, marketplaces tend to have a lot less value, because the market power is held by one side of the marketplace, and the number of transactions may be smaller if you have high concentration, and marketplaces are just much harder to build and often impossible if you have high concentration. So you typically look for fragmentation on both sides of the marketplace, which is certainly true in what we were building with Full Harvest, connecting farms with food and beverage companies. The second piece I would say is the frequency of purchase. So how often are your buyers purchasing the product and sellers selling the product? The less frequent, the less valuable a marketplace is. If you go and you set up a year contract and that's it, set and forget it, a marketplace doesn't make nearly as much sense than if you're buying daily or weekly or even monthly. The more frequent the transactions, the more valuable a software enabled marketplace is. The third thing I would say is what do the connections between buyers and sellers look like, or what can a marketplace help create? Do buyers want to work with multiple sellers? Do sellers want to work with multiple buyers and continuously change who they're working with, or add buyers, add sellers? The quote unquote multi-tenanting on a marketplace is really important. If it's a situation or a sector where a buyer wants to find one supplier and work with them forever, it's really hard for a marketplace to have a lot of value. But if a buyer wants to have a lot of different suppliers and constantly try to for the buyers, that is really valuable for a marketplace situation. The last thing I would say is payment flow. So, and we have this at Full Harvest. I've seen marketplaces that have not had this, and I think it's really hard to do. What I mean by payment flow is how does the money flow from the buyer to the seller? Does it go directly from the buyer to the seller, and then some portion of that gets taken out by the marketplace? Does it flow through the marketplace and the marketplace takes out a cut of it? what I've seen, what I believe is the most successful approach is to have the money flow through the marketplace. The marketplace can take out the cut. Hopefully, it's a relatively large cut or whatever makes sense for their business for that market. And then the seller gets the net amount. The reason for that is two big things. Number one, ease of use. If you have to, if a buyer is sending money to a supplier and then also to a marketplace, or a buyer sending money to a supplier and then the supplier has to send money to the marketplace, that's just extra friction in the transaction that a software-centric marketplace should be avoiding and reducing. The second thing is, if you don't have the money flow through the platform, the transaction fee ends up feeling more like a tax, whether that's to the buyer or the seller or both. If a buyer has to send a separate check or separate wire to a marketplace, that they're going to feel like they're being taxed for that transaction, as opposed to this is just a service and the marketplace takes a small cut. And so you don't want to have a business that feels like it's a tax. You want to have a business that is reducing friction and feels like it's a great service, and then the money just gets taken out on the back end. So those are probably the four key things: fragmentation, frequency of transaction, multi-tenanting, and then payment flow. And there's a number of others as well.
Hey there. Quick break to remind any founders or VCs listening, if you are looking for deal flow, seeking to raise funding, looking for partners to help service your needs, or perhaps you're looking for corporate investment partners, feel free to reach out to us through our Slack channel, which can be found in the description. Because we meet a lot of people in this space, we set aside time each week to make introductions to the various people that we encounter. This is something we do free of charge in order to help these incredible companies solving climate change to scale. Looking forward to hearing from you in the Slack channel.
Do you think there are any nuances to marketplace transactions within climate in areas where you have more regulation? The reason I say that is because there are some marketplace models, for example, around energy and utility mapping and all of that, that has to do with marketplaces, but there's added friction because of regulation that makes things a little more complicated. So some of that free-flowing market forces aren't really possible. And so there's this essentially generation of climate founders who are trying to apply relatively free marketplace models that you got from, eBay, other just like more free online marketplaces to more regulated industries. Have you looked at any companies that are trying to do that recently? And do you have any thoughts on things that you found interesting versus things that weren't really relevant?
Yeah, it's a great question. I would break it down into, what is the regulation regulating? Is it regulating price? Is it regulating other things? I think that regulation can be a huge hurdle for startups to break through, but if they do break through and they can integrate or play nicely with the regulators, that can be a huge competitive advantage. And ultimately, if a marketplace is reducing friction, reducing cost for buyers and sellers, and making things easier, regulators should like that. That doesn't necessarily mean they will, but it really, regulation is going to have various impacts on the ability for a marketplace business to even make sense, and then a huge impact on can an upstart business, a startup, break through that regulation or work with the regulators in an effective way to create a marketplace. So the short answer is it depends. I've looked at marketplace businesses across ClimateTech. There's a lot of tax credit transfer marketplaces out there. I'm looking at a couple right now. That space is the regulations and the tax guidance around that are continuing to evolve a little bit, and I think there's an opportunity for those marketplaces to create a lot of value there, especially if you can execute effectively and work within the regulations and build an effective product around that. It's a very crowded market. So again, back to the earlier point about picking the right team and the right vision for what you're building in that space. Hydrogen, I recently met I'm going deep on a hydrogen marketplace that is, I haven't met a lot of companies in that space. Hydrogen is still early days in that market overall. It's expected to grow massively over the coming years and decades. And it's a really interesting market to be building a marketplace business in. There's all sorts of challenges around transportation. There's also a lot of questions and challenges around tracking the carbon intensity of hydrogen. Is it green hydrogen? Is it brown hydrogen? Is it somewhere in the middle? And being able to effectively track that and price that and take into account the carbon intensity, so you can get carbon credits for it, or take advantage of the various federal incentives for green hydrogen. So there's some elements of the hydrogen space that I think are great for a marketplace business, in that the transportation has been difficult and hard to coordinate, and then the tracking of the carbon piece. So that's an area I'm really, really interested in, and far less crowded than tax credit transfers today.
What do you think about investing in hydrogen in terms of the near term, given that there's some concerns about how fragmented the supply is, versus the long term? Like, is there a timeline at which you're really going to look at investing in hydrogen marketplaces?
Great question. So no argument that the supply is relatively concentrated today. That is for sure. I do expect that it will become more fragmented over time, significantly more fragmented. That will take time, though. That's not going to happen next year. My time horizon is a 10-year time horizon, and so within that 10 years, I absolutely believe the nature of the fragmentation on both sides of the marketplace will be sufficient for a marketplace business to be successful. The second piece to that is, in the interim, can a marketplace capture the existing suppliers in an effective way? The highly concentrated side of the marketplace, can they capture a few of the big suppliers to make an effective marketplace? The particular business I'm looking at has been able to work very closely with one of the largest suppliers, and is in conversations with others. So it's, in the interim, can you build a marketplace? Can you effectively work with those more concentrated suppliers as the industry matures and becomes more fragmented? That obviously is if I make that bet, that's a bet that I'm making. But you're right that the dynamics today are not ideal for a marketplace business, and over the long term, I expect that to change. The second thing I would say is, marketplace, especially B2B marketplace businesses, have a number of opportunities to kind of sell other services to their customers, whether that be suppliers, buyers, or both. And so in the really early days of any startup that's building in the marketplace business, these businesses may evolve to look more like a SaaS business, or layer on financial products or other things. Now, I'm not necessarily betting on that, but there are a lot of different ways that, if you get in with buyers and suppliers, that you can add value, where it may not end up being just a pure marketplace business.
Yeah, I think that is, generally speaking, like, probably a really smart way to look at it, because I think you can essentially set yourself up to be integral in any marketplace that could happen, or solve any sort of like system-wide issue that could prevent like a free-flowing market, or prevent a monopoly from happening and drive competitive pricing. I think that's like an area that it's really hard to predict where that's going to go, because you don't even know the pockets that are really going to succeed yet. But once they do, then it's a lot easier in terms of the grid to navigate all of that. I wanted to get your thoughts on that, because honestly, it's something that people have very varied opinions on. I think like there's some optimism, like you said, and there's some situations where there's just like, nope, I think big industry will just move too fast for this to matter right now. Too expensive to integrate into the grid. So I really appreciate that. One thing that I'd love to transition to that we haven't really gotten a chance to talk about yet is, when you are like evaluating your investments and you are going through like what is climate, what is not, can you talk about the different things about climate tech investing that you pay attention to? Are you looking at the impact on decarbonization? Are you looking in like at does this support certain goals? How are you evaluating a company's relationship to climate?
Yeah, absolutely. Great question. Ultimately, I'm typically investing in picks and shovels businesses. So I'm not investing in the deep tech that is, pulling carbon out of the air, or decarbonizing cement or steel, or something that is very, very directly reducing uh, carbon emissions. Like Tiba is helping make energy storage more efficient and effective in the development and operation of it. That is a picks and shovels business. And so I believe that is 100% a ClimateTech business. Um, how much credit do they get for the uh, billions of dollars of energy storage that they're going to, help enable over the coming decade? Not up to me to decide that. Ultimately, we need these businesses. We need these equity light businesses to enable the hardware to be deployed faster and more efficiently and effectively. And so I do not have a hard rule around what are the carbon reductions that you are creating. But at the same time, the business very clearly has to be in climate. Climate can't just be a secondary product that they're selling, or one segment of their customer base. It's got to be really core to the product and the mission. So that's how I generally think about the kind of overall climate impact.
Got it. Thank you for that. And I think it's interesting. You talked about like people who can make direct investments, and that kind of technology is, you're not really sure about it, but it's very clear that it has potential. Like recently, I've been looking to a lot of like carbon accounting and carbon calculators and balancing scope 1 versus 2 versus 3 emissions. Like how accurately can you really get into scope 2 and 3? But what's interesting is I've personally been reading a lot into the IRA. GGRF is one of the main pieces of legislation that focuses on allocating capital based on investments that can actually qualify scope 1, 2, and 3. When you're investing in companies, like you mentioned, some of these things are hard to quantify. Are you investing with the types of blended finance that companies could approach and target for in mind? Or are you still looking at it primarily from okay, let me invest in a technology, in a team, in a company that would work, and then the rest is afterwards, essentially, especially being early stage?
More the latter. I think because most of the companies that I'm investing in are equity light software marketplaces, there are less opportunities for blended finance than other types of businesses. That's not to say there are none. And if companies can take advantage of non-dilutive financing, I certainly hope they will and do, if it makes sense for their business and makes sense for them strategically. And I have a couple of portfolio companies that have, but I'm generally not investing in companies that are going to need or going to have a ton of opportunities to take grant money or government funding or other things. So more the latter, that I'm really focused on just the team and the technology, and believe that they won't need to raise a ton of money over time to be successful.
When you're going into like a conversation with investors, a talk, and there's the topic of blended finance. Like, do you, as an equity light investor, do you take anything away from those blended finance conversations, talks? Like Climate Week had a lot of them. Do you find yourself learning or finding some parts of it interesting, or is it mainly just a distraction for the kind of investing that you do?
It's a critical part of the ecosystem, and to the extent that there are companies that can help other companies leverage those that financing, or to the extent that there is an equity light business that can take advantage of it, it's certainly important and interesting. Um, it's not an area of focus, but it is critical for the broader climate space. And I know that some companies that I'm involved in will take advantage of that, or I will invest in. So it's important. It's something I stay close to. It's something I think a little bit about, but it's certainly not my focus.
Got it. No, I think that's super helpful because, for example, anyone who's inspired by this conversation is like, oh, let me still try to apply some of that equity light software mindset to climate. I think right now, majority of the content, there's, especially with COP, the onset of New York Climate Week and sort of the fallout from that, there's been a lot of enthusiasm and a lot of like questions about blended finance, green banks, the different legislation coming out, a lot of these other, later stage funds, venture debt. So there's a lot of questions just about like, how is it actually all useful? And I think it's important to say that, sometimes it's just not. And it's important to recognize where it's not as well, because I feel like a lot of people within climate are trying to learn as much as they can. And so that tidbit from it's great to hear that there is some segmentation and there's some, it's important, but it's not all always relevant to what you're doing. So I found that really interesting. There's one thing we have, what we call an insights portion of the show, very similar to a lightning round. But before we transition to that, the one thing I want to ask is something that's come up recently with relation to founders and evaluating team. So as an early stage investor like yourself, this is probably extremely important. In climate, not every founder comes from their industry, right? Like, for example, if you're looking at hydrogen, there isn't really a 10, 20-year history of the hydrogen industry at scale, right? So you're not always going to find a founder that has come from some big company within this space, right? And I think that's a proxy that people used in software or even just investing previously, that this founder comes from a similar industry or the same industry. And in climate, you don't see that happen as much. I think it's growing, but you don't see it happen as much. How do you evaluate, and what are the things and proxies you look for within founders when you are evaluating an investment, especially early on?
I think for founders that don't necessarily have deep experience in the area that they're building, I really try to understand, what have they learned? What is their unique insight? Why are they building in this space? If they don't have a deep background, and what skill sets have they brought? What does the founding team look like as a whole that suggests that they can build something unique and execute? How many conversations have they had with potential customers to build out their vision and their thesis for what they're building? With pre-seed companies that are pre-revenue, they may just be building out their product still. The metrics, quote unquote, that I look at are, how many customers have you talked to? How many conversations have you had? What are your key learnings? And really trying to understand how deep they've gone, and what they are taking from their past experiences that may be relevant to what they're building. So that's a big piece of it. It's really also just understanding them as people, what drives them, what motivates them. Are they looking to build a company for a couple of years and retire, or have they found their life's work, if you will, and they want to be doing this for the long term? I much prefer the latter, not surprisingly. And so really understanding those underlying motivations and drives and desires is critical, regardless of whether they have experience, frankly, in the field that they're building in. So those are a couple things.
I appreciate that. I think one follow up on that is unique insight of a founder. Oftentimes, is there a general type of unique insight that you find? Like, is it industry insight? Is it their insight on how to manage a team within climate? Like, is there a very common type of uniqueness that for founders, or is it pretty much spread across different qualities?
Yeah, I would say unique insight on the market's going to be going to come from a couple different perspectives. So I'll use the Tiba example again, right? Michael Baker kind of had experienced building what he was building within a company and saw an opportunity to build it as a standalone business. And he had that deep industry knowledge, had been in the industry for a lot of years, and had seen kind of the challenges and opportunities around what he ultimately built with Tiba. And so that was a unique insight that he had. Other unique insights may be somebody who's much newer to the market and just approaching it with a fresh perspective and bringing to bear learnings from another industry or an adjacent market that hasn't yet been applied to the market that they're building in. A third area would be somebody who is really technically savvy in it with a specific type of application, and is bringing that to bear in a different way to a market. And so that kind of deep technical expertise. And often in a founding team, it's great to have a combination of that. You have somebody who's deeply passionate about a market, really understands the customers and the problem. You have a co-founder that's deeply technical that can bring unique technical expertise to bear, and having different flavors of the unique insights and skill sets is really, really powerful.
Okay. Yeah, I appreciate that because I think it's always really interesting to see how people, given that if someone's not coming from the industry, how do they get the actual insight that they came to? Those journeys have always been, I think, like good learning opportunities for anyone who's sort of a founder hopeful. How can you replicate that for yourself, right? So I appreciate that. Yeah, I think,
One
yeah,
thing to add there too would be, I think there's, even if somebody comes from the industry, there's no shortcut to talking to dozens or hundreds of potential customers. Like getting that deep understanding of what their pain points are, there's really no shortcut to that. And some people like to use the like Steve Jobs analogy of he knew better, he knew what was right for customers, and maybe for some consumer products, and if you're Steve Jobs, that works. But I think especially in the B2B space, like deeply understanding, what is the problem that you're solving for, how are you going to solve it for the customers, what is the initial market that you're going after, what is the ideal customer profile, and that takes a lot of conversations, and there's really no shortcut to that. And so regardless of whether you're coming from within industry or from outside of industry, seeing how deep a founding team goes there is really, really critical, and a great sign. If the deeper they go, the better.
yeah, I think there's always those like analogies to like founders and VCs and there being like a marriage relationship or a long-term relationship. I think that it's something that I feel like a lot of founders say that they underestimated before they went into something, especially the repeat founders. They develop an appreciation for the people that they've been able to build rapport for. Um, the next portion of the show, and sort of like probably take us towards the end, looking at time, is what we call the insights, which I mentioned is like a lightning round. So I'll ask you about a couple different topics that we know people love to hear about, and just give us your quick take on them or quick story about them. Does that sound good with you?
Yep.
Okay, perfect. So the first thing I'd like to talk about is something we lightly touched on before, is climate and AI. And so I think this actually goes very, very heavily with your experience. How do you believe AI is impacting climate, and where is AI most relevant in the overall like climate tech ecosystem?
Really good question. I would say it's limitless as to how it's impacting climate. I would say the one area that I'm really excited about within the broader climate space is in the built environment, and how we can leverage AI to identify and recommend opportunities to upgrade and decarbonize buildings and make them more efficient. There's a fair amount of low hanging fruit there that I think the more recent advances in AI can do really, really cost effectively. I haven't yet made an investment from Virta in that yet. I've seen a lot of companies doing some really interesting things there. It's a space that's frankly gotten pretty crowded pretty quickly, which is a good sign for customers and for the impact that it can have. But that's an area that I'm particularly excited about, because ultimately, when they think about the built environment, especially in the commercial and industrial space, the least carbon intensive are the buildings that have already been built, right? So um, if you believe that is the truth, then how do we make those buildings more efficient, run more efficiently, decarbonize them, to a certain extent electrify them? And there's a huge opportunity for AI to play there. I would say the second piece, and not to uh, come back to Tiba again, but the electric grid and the management of distributed energy resources, batteries, and the broader electric grid is going to become far more efficient as we layer on AI across the electric grid. It's going to take a long time to do that. Utilities don't move particularly quickly. They're hard to penetrate. But I think there's a huge opportunity there to bring AI to bear to make our energy grid far more resilient and effective, particularly as we add more and more renewables to the grid. It's going to have to be, constantly balanced, and AI is going to play a huge part in that.
Amazing. The next section is about your existing portfolio. So, what is one of the things that one of your portfolio companies has done super well that you wanted to share?
Yeah, I won't name names on either one on the what they've done well or what they've done poorly. But one thing that I've really appreciated one of my portfolio companies has done is they have created a discipline around bringing their investors to the table to get feedback, get advice. They basically created mock board meetings once a quarter. They've really held themselves accountable to understand what their metrics are, how they're trending, what they're doing, bringing the big questions to bear with their investors. And I think it's going to set them up really well for when they have a formal board of investors after their next round of fundraising to execute really, really effectively and take advantage of the value that investors can bring, and also hold themselves accountable by regularly reporting internally and externally. So that's been really great to see, and I'm excited about what they're doing there.
I appreciate that, and definitely respect the privacy there. It would probably make you look not great to be sharing their stories with a name right out there. Great, and the last part of this section is the ideas part. So this is something that we like to ask a lot of VCs. I think it demonstrates, especially in areas where they have conviction. If you had to quit being an investor right now and build, what specific space in climate would you build in, and why?
It's a great question, and I would say the broader electrification of transportation industry. It's there's been some bad press, or I would say the bad press around EVs and EV demand softening and things like that, which I think is a short-term blip, and long-term, I think everyone believes that the electrification of transportation is coming. It's going to happen, and in certain areas, it's happening faster than others. But that it's still such early days. I mentioned 7% penetration in the U.S. of new car sales as electric. 10 years from now, I think that's going to be well over 50% and hopefully closer to 100%. And that is such a massive transformation. And that means that has a whole set of ramifications around what that means for the electric grid, what that means for how we operate vehicles, both for consumers and businesses and fleets. And that transformation is really, really exciting. And I have a couple investments there that I'm obviously very excited about, but there's so much more to be done there. And I think there's problems that we haven't even identified that are going to come up, and challenges and opportunities to build companies around the broader electrification of transportation.
Got it. No, definitely. I think, especially within transportation, transportation is much more than just consumer vehicles. There's a lot of room within freight, within maritime, within getting things around, and non-conventional understanding that is really, really relevant. And I think the more important thing is a huge market size for that, especially in optimizing those and building out routes combined with grid charging, optimization, things like that. So I really appreciate that. I know we're running up on time, so I would love to get to the advice to founder section before we let you go. So just generally speaking, this is especially relevant to my co-host who runs his own recruiting team in climate. What is your advice on hiring a founding team, especially given that you work at the early stage? Some of these founders are looking to bring people in at probably the most important part. What is your advice to founders on hiring a founding team?
You got to get it right. if you get if it's not a founding team that has worked together in the past, it's the bar for bringing on a co-founder has to be higher than anything else, because if you get it wrong, the chances of success for the company are very, very low. And so have the bar really, really high, take your time, make sure that it's a co-founder that you really want. I think it's, again, if it's somebody you're bringing in and it's not somebody that you've already worked with before, think really hard on whether you even want to call them a co-founder. It's obviously a good enticing thing to get a really experienced person on, but if it doesn't work out, that's a big challenge for the company, and could destroy the company. And so make sure you need a co-founder. Find somebody within your network, or somebody that you ideally had some experience with in the past. And if you can't find that, then take your time. Try to bring somebody on, part-time, or work with them in some way for an extended period of time before you bring them on, because if you get it wrong, it could kill the company.
Definitely, I think that goes to just how important it is, and how much some investors bet on the team. Just knowing that the right people can figure out the situation. The last question I'd love to throw at you is in the similar advice, advice on fundraising and advice to founders who are looking to raise, especially in climate.
Yeah, absolutely. I would say, first and foremost, when you're reaching out to investors, try to get warm introductions, ideally from other founders. I get most excited when one of my founding teams says, "Hey, I know this entrepreneur and they're awesome, and you should meet them." I almost just instinctively say yes, and almost no matter what they're doing. But getting warm introductions, and specifically warm introductions from other founders, is really, really helpful. In addition to that, know your business back and forth. Having deep customer insights. If you have a product in market, know your metrics really, really well, and just be prepared to go really deep on all elements of the business. That's absolutely critical. And the third thing is the storytelling piece. Be able to talk about what the long-term vision is in a really compelling way, and then be able to take a step back and talk through how you are going to build the company to achieve that. Visionary, but also grounded in reality of what it's going to take to get there, and showing both of those skills and abilities, I think is really, really powerful and important.
Definitely. I think, especially in trying to understand that the way that you're going to get to your goal in climate is probably a little bit more complicated than, your average software model, or even if you're doing software in climate. I think the storytelling aspect of it is extremely important, because people need to be able to buy in to where you want to go, because it's not going to be linear. So they can't just always leave you on autopilot. And I think that's something that is very unique about founders in climate that I appreciate you sharing. So yeah, well, look, man, I loved having you on. It was a real pleasure. I know we're basically at time, so I just wanted to end it by asking you, where can the audience find you? And if you have any asks for them, just feel free to say it now.
Absolutely. Reach out to me at russell@virtaventures.co, not .com. So russell@virtaventures.co. You can connect with me on LinkedIn as well, or find one of my founders. And if you're connected to them, reach out to me through them. Any of those paths are great, and would love to hear from you if you're building an equity light climate tech business.
Definitely. And of course, if you want to talk to an Emmy award-winning VC, Russell's your guy. So that's amazing. So listen, man, this was a great show.
Great.
Really have you on. All right.
Awesome. Thank you.